Okay, hello everybody, and welcome to Investing with IBD, sponsored by MarketSmith. Today is August 12th, 2020. I'm your host, Arusha Pierce, and today we have Mark Minervini returning back to the show. Mark is a founder of Minervini Private Access. He's an author and also was featured in Stock Market Wizards. Thanks for being here, Mark.
Happy to be back.
On today's podcast, we are going to talk about the current market. We will talk about the concept of developing sit-out power, and we will end the episode with a few current ideas. So let's get into the current market. The market is in an uptrend, but we're getting tested a little bit here. We have 3 distribution days on the Nasdaq and the S&P 500. Mark, what are your thoughts on this market?
So I think that what we have to look at if you're a stock investor is to start thinking stocks versus indexes. And, even indexes versus indexes, because when we talk about these indexes, you had the S&P 500 moving sideways for a while, while the Nasdaq just kept, charging ahead here.
Right.
And if you take a look, the Nasdaq hasn't had but more than 2 to 4 days down and not more than about 5 or 6% pullback through the entire rally from the lows, that started back in March. So all these pullbacks, this is what I call a lockout rally, where it essentially locks out buyers that are looking to buy pullbacks. If you're not quick and you're not buying shallow pullbacks and you're waiting for a big correction, you've been left in the dust here.
Yeah, and this is, you can call it a wall of worry, or you could call it the ultimate wall of worry.
I would call it the ultimate wall of worry. I'm not sure there's been a wall of worry, not in my lifetime, that's for sure. That's been this. So if the market climbs a wall of worry, then we've got some climbing to do.
Yeah, and so talk about the concept of wall of worry for those who are new. What is going on really just kind of underneath the surface when there's just so much kind of fear out there and a lot of bad news, but the market just continues to crawl up higher?
Well, the market's a discounting mechanism. So even with like GDP being negative, people start getting worried that they see these negative numbers. What happens is if you take a look at history and you look at the statistics, you'll find that when earnings are down and when GDP's down, the market actually does the best because it starts to anticipate and discount a recovery. So it's sometimes hard for people to understand that the problem is that you never know if the market's looking out 3 months, 6 months, 12 months. So it's a matter of how far out it's discounting.
Mm-hmm. And a lot of times the best way to do this or really participate in these trends is listen to the market, watch the price and volume action, and have rules that will slowly put you in the market when the time is right.
Right. So we went back into stocks. I got out of the market 3 days off the high. It was probably one of my best sell signals ever. Got clients out and started selling stocks right off the highs. And then we had a 9,000 point decline, which we completely sidestepped. So this was I was quite fortunate, through this bear market or whatever you want to call it, this crash.
Right.
And then pretty close to the lows, we got back into the market. And that was on April 6th.
Right.
Started buying stocks again, and then got very aggressive as the months progressed. But I got to tell you, if I listened to my gut and I was to really look at the world and what was happening, I wouldn't have bought a single stock. But what happened was, we were talking about it in my office, and I said, look, we gotta buy these stocks. I mean, they're setting up. There's setups everywhere, and we gotta trust the strategy and trust the setups. If we get stopped out, we get stopped out. But we've got to buy. We got a follow through day. Okay, so even the O'Neill people, you got your follow through day and you got setups, and that's all you need to see.
Yeah, and you brought up a good point here on we had that fall through day on April 6th, and it's really scary to buy at those times. Even if you sidestep that vicious pandemic sell-off and you're happy and you're sitting in cash, it's still very, very scary to buy that time. But that's why those rules are there to force you to start moving in bit by bit.
Yeah. Well, I found that when people are very scared, usually especially if they've been scared for a while,
Hmm.
it's usually a better time to buy than when everybody's happy and celebrating and giddy. That's when you start to get really, really happy and everything's wonderful and you feel like you can't make a mistake, that's when you really got to start, I always tell people, always prepare for the other side of the trade. So if you're in cash, start preparing to go long. Start looking for the signs that will tell you to go long. If you're fully invested, you're on margin, start looking for the signs to nail your profits down, to sell, and to cut, fish or cut bait. So that's always look at the other side of the trade. Whatever side you're on, always be ready for the opposite side.
No, that's really good advice. Now, the other thing is sometimes these markets, everyone's like focusing on the larger markets, and they're focusing, especially more normal people who aren't really watching this, they're going to focus on the Dow. But but I know you have found this, and I've definitely found this too. The better gauge these days, at least in the last number of years, is by looking at a lot of growth stocks to get the gauge of kind of the gauge of the health of the market.
I found that that's been the best way to do it for as long as I've been doing it. And I've been trading stocks now for, I think it's 37 years this year, right around 37,
Amazing.
38
Yep.
years. So it's been a long time. And I haven't found a better way, even though I do look at the index at the end of the day throughout I remember we were talking about this the other day. I didn't even know what the Dow did. And I asked
Yeah.
you, what did the market do? I,
Right.
I don't even know what the market is doing half the time. Sometimes I might see it on TV or I have it up on my screen, but I usually minimize my indexes and all I do is just focus on the stocks, my watch
Mhm.
list, my buy list, and my portfolio, my holdings. So that's where I get all the cues from. And if I see a lot of stock setups, no matter how bad the news is, I'm actually not scared at all. I get very excited because I know the stock setups are, especially my favorite scenario is what we had coming out of this bear market and this COVID situation. It's when everybody's terrified. Everybody's saying it's the end of the world, but there's tons of setups. That's my absolute favorite situation, and that's what we had.
Yeah, and I mean, essentially, what that's saying is that there are all these growth stocks that they're saying they're ready to go. They're
Yes.
just needing the market to just give them a little bit of a signal that we could start trending higher.
Exactly. I was talking about also with the Nasdaq how it's been marching up. Also, the Investors Business Daily 50. If you look
Hmm.
at that, that hasn't closed. I'm not sure if it's even maybe a day or so, but it hasn't closed below the 20-day. And the Nasdaq also, has been holding the 20-day through this entire move. So that's a really powerful rally, and it's also showing that the right area of the market is doing well because you can have the Dow marching higher, and there's been times where it's been going for months and months and months and it's up 15-20%, and I don't find many stocks and I'm actually in cash during that whole period. And then there's times where the Dow moves sideways for 4, 5, 6 months and I'm hitting it out of the park and just trade after trade after trade, and there's just tons of setups. So again, I don't really focus on the indexes too much. I'm really looking at the individual stocks for my cues.
Now let's talk about this concept that you made me aware of, and I like the way you look at it: the easy dollar environment versus the hard penny environment. Go into that and give your insight on how you use that.
Well, it's just tracking and gauging your own traction that you're getting in the market, and whether you're seeing your buy list, your watch list, whether that's growing, if you're seeing a proliferation of names setting up, and if they're working, and if you're seeing things working, and you're not feeling much pressure in your portfolio, you may get hit with some stops, but you're on balance, you're making money, and there's just not a whole lot of pressure. That's what I call an easy dollar environment, which means that you're making large amounts of money in a very easy fashion. The opposite is when you have a difficult environment. Everybody can relate to this, where
Yeah.
stock breaks out, reverses. Next thing you know, you're at a loss, and you're getting stopped out left and right, and you can't seem to make any money. That's what I call a hard penny environment. It's actually hard to even make a small amount of money. So when you're having a difficulty even making a small return, you got to be real careful. And when things are going really well and you're having an easy time making a lot of money, that's where you got to press the pedal to the floor, and you've got to gas it. And that's the difference, I think, between really great traders and everybody else, is that good, traders that are experienced, they know when to really jam it and step on the gas and really get aggressive, and also when to ride the brake and to get out completely and just sit and watch.
Right. And so let's go over some stocks that you were picking during this time, during this pretty incredible rally, and we'll walk through a number of them, and then we'll take a quick break too.
Yeah, sure.
So the first one is Vapo, and let me pull this up here, and if I can spell them properly. Okay, here you go. So ticker symbol is VAPO, and okay, so we have this on the chart.
Right.
And where was this coming up on your radar, and where were you entering into it?
Right. So we bought that stock on 4/23.
Okay.
So on April 23rd, so that's just, not too much longer after, like I said, April 6th, when we started going to stocks.
Yep.
So this is one of the early names, that I recommended and bought. Now, I traded out of it pretty quickly. It ran up 30-40%, and I made a nice quick rip on it. And then it pulled back a little bit, kind of felt pretty smart there, because it came all the way back from that above 30 back to 22, but back to the breakout. But then it set up again. It set up that what I call the low cheats, my classic little pattern there, the low cheat. Came out of there. We highlighted it there to our members, and it just ripped from there. Now you can see, of course, recently it's gotten clobbered and it's given back a huge portion, but that stock went up about 175% in just a few months. So, see, this is how you get leverage from the market. People talk about leverage and they talk about margin. I get leverage by buying powerful stocks. So, and that's how you leverage the market. If you are buying very powerful situations, what happens is, and I'm talking about in a bull market, you start a new bull market, you get a follow through day, the Nasdaq goes up 25-30%. Guess what? The leading stocks, if you're in the right names, are going to go up 100-200%. And even in a short period of time, you might get 20 or 30% just in a few days or a few weeks or a month, and you can compound it very rapidly.
Yeah, and that's a good point. You don't always have to go on margin to get the power of some of these growth stocks in a great market.
No, I don't use margin anymore. I don't need to. But even when I was only dealing with a small account, only for the first few years did I go on heavy margin. And I rarely used margin, even when I was getting, huge returns on that people have read about in, stock market wizards, and those days where people think that I was, so aggressive. Yeah, I was pretty aggressive, but I could tell you right now, I was not on margin hardly ever.
That's really interesting. Let's go to the second stock here. This is BVXV, and so I pulled this up. And where were you telling your clients about this stock?
Yeah, so this one also just came ripping out, and like I said, this is a market that is just really a great market. And I at least up until recently, in the last few weeks, it's gotten. I think we're in a hard penny environment now, but we first highlighted it on 619, where it came through that classic low cheat. Then it tightened up and came out on 7/6. So it was July 6th. Let me just make sure that's correct.
Yeah, it looks like that was July 6th right there.
Yeah, July 6th. Yeah, here it is. So on July 6th, that's where it was a buy. And then you see 1, 2, 3, 4, 5, 6 days. Yeah, in 6 days, 6 days, the stock was up 145%. I mean, that's a rocket move. So those are the kind of moves that if you can time those, a few of those, and you're fairly concentrated, you can rack up, can compound a very large return. People, always want to know how I got those big returns with the low drawdowns. It's buying in the direction of the trade in very powerful situations and getting this type of situation where I can very rapidly roll out, take a nice big profit, and then move into another one and not experience much pullback because I'm getting those short-term thrusts.
Yeah, and I think the big key is taking the gains when you have them too, right? I mean, a lot of people, once they start, if they're up 140% in these, they don't want to sell at that point. What if it goes up 500%?
Right, exactly. Well, again, I take profits a lot of times at 15, 20,
Mhm.
25, 30%, and they go up 100%. And still, I've put down triple digit returns where I have in years where I never even had a triple digit stock. So you don't have to have a triple digit stock to do triple digit returns.
Let's go to the third stock. This is PRTS, carparts.com.
Right. So I very rarely, and most of these names, not at the exact time where I was buying them, but I usually put them on Twitter shortly after. Otherwise, clients would get a little upset that pay me for this stuff. But,
Right.
most of these I talked about on Twitter, and then of course, I want to point out too that we're looking at some of the really powerful trades here. I've got just as many losses. I'm going to be stopped out of a trade about half the time. As a matter of fact, since April 6th, I've done approximately 125 trades. I think it's maybe a few more now. 125 trades, and my batting average was a percentage of winning trades was about 44 point something percent, about 45%. So a little less than 50-50. But again, my gains are more than 2.5 times my losses. I think at 2.7 times my losses. So almost 3 times my losses. So if I'm losing, 5% on average on a loser, I'm making 15% on average on a winner, and you're going to make a lot of money if you can roll that over. Anyway, getting back to this PRTS, you can see this tightens up really nice. It's just a perfect power play. And again, this stock moves. And again, this was just a new high ground yesterday, and it reversed. So it's still holding up quite well. It's up about 75%, in just, I don't know, what's this, 4, 5, 6 weeks. So again, I'm already out of this. I like to hear the cash register ring, so I, get out of them very quickly. So there's been a bunch of these names. Real quick, too, I don't know if you could bring up XPEL.
Yeah, let's bring that one up.
Because this is one that I bought this from what would be a signature low cheat set on 720. And a lot of people would not buy it there because they'd be waiting for it to make a new high coming out of that big handle. It's just a big cup with handle, but sometimes I can buy on the handle if I get a cheat area or a low cheat. And of course, if you don't, this terminology is my terminology. So it's so
check out his books.
Yeah, it's in my book. It's all explained in my books. If you don't know what I'm talking about, low cheat. But anyway, this stock, another one went up and, very quickly up 20-30% on it. Got out, and today,
look at that.
Today it was up 32.9%. So so I know I had some of our members, send us emails and say that they held it and they free rolled it, which means that you get a good gain. This is a perfect situation. Just to point out, you get in a stock like this, it runs up, let's say it runs up 15-20%. You kick out half of it, or maybe you kick out 75% of it, and then you go into, say, an earnings report, or you want to hold it for a bigger move. You move your stop up to break even, and now you're free rolling. So let's say that you have for argument's sake, you have a 5% stop, and the stock goes up 15%, right? Or even 10%. Let's say it just goes up 10%. It goes up 10%. You sell half. If you let that stock now stop you out, you actually break even. So you just financed your risk. Now, if you move your stop up to break even, you're going to guarantee yourself 5% profit, and you could play it for a bigger move. You can do the math. I mean, there could be bigger numbers, and you can have different ratios. But the bottom line is that once you get at a profit, your options now open up, and you can start using techniques to finance your risk, and then play for a bigger move like this, and go into an earnings report because now you have a cushion.
Yeah, and so a number of these concepts that you just spoke about here with the free rolling and just kind of how you're gauging your risk, you talk about that in your second book, right?
Yes. Yep. There's more on those techniques in the second book. Yep.
Okay, so let's take a quick break here, but the market continues to be in an uptrend, but we're getting tested a little bit. The market's pulling back, but obviously keep building your watch list and keep a close eye on how some of these growth stocks are acting near support areas. When we return, we are going to talk about the concept of developing sitting out power. We'll be back. I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks just on the U.S. I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020. Mark Minervini is our guest on Investing with IBD, sponsored by MarketSmith. Okay, Mark, let's get back into some more stocks, and then we'll get into the concept of sitting out power. I'll pull up LSCC. This is Lattice Semiconductor. And so this is another one that you added onto your list.
Yep, and this was a purchase on, let's see, the date on that was on 4/29, April 29th. Okay. So you see, again, early, pretty early in the uptrend. Yep. And the semis, really started to show that they were, doing well, maybe, a few months after that. It's a big group. So there was a lot of stocks that incrementally started moving, but this was one of the earlier movers in the group. And again, that's just pulling back to the 50-day now. I'm long gone out of it, but this is another one that made a pretty big move. I mean, we're talking about from that point coming to the buy point, that went up about 50%. So yeah. you got a lot of names that another one is Samuel Adams, SAM, which that's another one that I definitely sold this one way too early. I knew I was selling this one too early, but I started getting. There was a lot of stocks getting extended, and I wanted to pare back on my exposure. But again, going in, you can see here, let's see, I'll get you the date too on that one. That date is, I got to move this thing out of my way, this Zoom thing. That was on 7/7.
Okay, yep.
So that was a later buy. Yeah, that was bought on 7/7, coming out of that little base there. Very powerful. It came up right off the lows, and that was the first time it consolidated. So coming out of there, and you can see it just grinds up like every day. And then I believe went into earnings, and then just has a pole vault, on that big day there. So again, another nice move. I mean, coming out of that little base here, that ran up another one that about 50%. And
this is another great example of a VCP type of action, or just tightening up and setting up after this really strong move up. It takes a month off, just gets the volatility decreases, sets up, and then takes off from there.
Right, and the VCP concept has become very popular over the years. That it was something that I put together years ago when I wrote the books. If it's volatility contraction pattern. If you want to learn about that, you can read my books, of course. But almost every single trade that I make comes from a VCP. The VCP isn't a pattern in itself, like a cup with handle is a VCP. My cup completion cheat, the low cheats, all of those all have VCP characteristics. So VCP is a characteristic of a pattern, not necessarily the pattern. I mean, it is a pattern, but it's a characteristic of a cup with handle or some of these other patterns. So, but it's an easier way to identify, when supply stopped coming to market and you're getting the line of least resistance formed, and you're getting a situation that can move very quickly. That's the key, is to be able to be at a profit as quickly as you can for two reasons. One, because you're compounding very rapidly, and two, if you get at a profit right away, your options open up. You can now move your stop. You can free roll the trade. You have options. But when you first take a trade, it's all risk. It's all downside at that point. You're putting it in the hands of the stock gods and hoping that the stock moves higher. It's an educated guess, of course. But once you get at a profit, now you're in control, and you can and you can make some changes, some portfolio management changes to be able to leverage that.
Now, one other concept that you mentioned in the previous segment that we didn't get to explain for those who are new to this, the power play. Just briefly explain what the power play is so we're all on the same page.
So the power play is basically a high tight flag. It's just in kind of renaming the tight flag, and because I have a few little different characteristics, maybe. Again, it's basically a high tight flag, and it's a situation where a stock moves very quickly in a short amount of time. Within 8 weeks, it doubles or more, and then it doesn't correct very much. And people a lot of times they'll say, "Hey, is this a power play?" And it's doubled and it's very powerful, but now it has a pullback or a correction of 45% in 2 weeks. See that, and that's too excessive. The whole reason why it's called a power play is because after it makes this big move, it doesn't give back much, and it's telling you how strong it is. It's not succumbing to profit taking. And then you look for the VCP characteristics for it to tighten up and have that volume come down so the supply stops coming to market, and then you get your buy point. But again, it's essentially a high tight flag.
Perfect.
And that's an O'Neill term, of course.
Yes. And so let's go to another stock here, and this is TSM, Taiwan Semiconductors, ticker symbol TSM.
Yeah, another one that I sold too early. But again, I love to sell early into strength and to avoid drawdown. I'd rather sell early than late. This is one that was bought perfectly as you can. It was bought on 7/1. And then the very next day gapped up the very next day, and just off to the races. And this is still holding up tremendously.
It is.
I mean, it's like really powerful. This and AMD was the other one. I actually bought AMD one or two times and got stopped out of it, but I stayed with it. I just hung with it, and I just want to see here. Hold on, because I had several dates that I bought AMD. Let's see the most recent date. So the most recent one, so I bought it. I bought it in May, June, and July. So I took some small losses on the first two. The third try was on 7/23.
Oh, 7/23. Okay, so just when it pulled back a little bit.
So what happened was, because I got knocked out of it 2 times.
Yeah.
I didn't believe the breakout on that day. So then the next day it pulled right back to the breakout, and I said, okay, I'm going to buy this right here, and if it doesn't just go, I'm going to get out. So I bought it, and the very next day I got a very happy surprise.
Seriously. I know.
It not only gapped, but it went up big, and it held it. So it was.
No, and this is, and there are some stocks, and AMD is one of these stocks where it can lie dormant for a while, and then when it wakes up, it like catches up to every other stock out there in a short amount of time.
I kept wondering why it was having trouble, because it had such good fundamentals. It had a lot of good things going for it, and I really thought it should go. But I've been doing this for 37 years, and I still won't trust my opinion over my stop. I mean, if it hits my stop, I'm out.
And that's a huge thing, and especially for those who are new, that's a characteristic that you want to develop as soon as possible. Now, another characteristic that you want to develop really quickly, but unfortunately, I think this one you have to just learn the hard way, is the ability to sit out when the setups are not there. Talk about this concept.
Well, it's easy to sit out after you've been beat up in a bear market and you got knocked out of everything and you lost a ton of money. Then people usually sit out too long. Then they sit out, and then when they see the buy set up, they don't even buy them because they're scared. But that's not what we're talking about. We're talking about sit out power to wait for setups to develop, and that could mean even if the Dow is moving higher. It could even mean sitting out if your friend is calling you and telling you how well he's doing, and if mutual funds are doing well, and so you have to have a strategy, and then you've got to gauge. If you're not sticking to your rules, you don't have a strategy. Even though if you have a strategy, if there's no discipline, you're not following it. So there's the strategy, and then there's the discipline to follow the strategy. Without the discipline, it doesn't matter what strategy you have. It could be the greatest strategy in the world. So sit out. I always say no forced trades, no big losses. No forced trades. Don't force things and start doing things that you normally wouldn't do, or start stretching and trying to make something out of something that's not there. You've got to get a very clear picture in your head what you need to see. to get in the market. And then even then, you don't trust it completely until you put real dollars and it starts working. All right. And that's what I call progressive exposure, which is, in my opinion, one of the most important things that you possibly, I can't tell you how many people that I've taught, to trade, and clients and people that work for me, that once they got progressive exposure, they said, wow, that's really what changed my performance. And that's simply, when things are working, you want to gas it. You want to get very, very aggressive incrementally. I'll take a few trades. We get a follow through day, go 25% invested. Maybe I buy a couple stocks. If they don't start working and they're not showing me profits, I don't go to 50%, 75%, 100%. I stay at 25. And if another few trades don't work, I go down to 10% invested. And if they don't work, I go back to cash. So now if they're working, I quickly go up to 50. If that works, I go right to 100. And, and then if you want to use margin, if things are working, you go on margin. But the key is to gauge if things are working or not. So you wait, you sit out, you wait, and then when you see what you need to see, you test it with real money. And if it passed the test, then you get aggressive.
Yeah, and that I think right there is the example of listening to the market. You are truly listening. You're waiting for the market to say, okay, slowly moving more. Okay, slowly moving more. Now go.
100%. And you don't want to be too slow once you get the confirmation. Like some people say, well, I followed the progressive exposure, but by the time I got fully invested, everything started correcting. Well, you move too slow. All right. Yeah. You don't want to wait for weeks and months. It might be a number of days. Things start working and everything starts popping and you see a whole bunch of setups. Okay, I got 3 stocks. They broke out. They're all holding. Okay, I'll add a few more. Maybe I'll go from 25% to 35, 40% invested. Oh, that's working. Okay, bang, I'm going to put a few more on here. So you move pretty quickly once you see, and that's the real difference between experience and someone who may be just starting out. It takes time to be able to make those to make those changes and make a shift on the fly like that.
Yeah, and now another thing, and if you haven't seen Mark teaching these concepts live, especially in a seminar, it definitely is. It's great, especially when some people ask you questions, Mark. But we won't go too far into that. We'll leave that for those who are in the seminar. But the one thing that's always stuck out with me, just watching you teach these concepts, is just the discipline you have. You have your trade set up, and you know exactly what you're going to do. And if it's not there, you're going to let them go. If you miss them, you're going to let it go. And that's it. You have your style, and you're not worried about anyone else or missing out on any stocks that don't fit that style.
No, people say, well, how long would you sit out if you didn't see any stocks? As long as it takes. 5 years if it took that long. Okay. I mean, that's literally the commitment that I have to my strategy and the trust in it. And I think I personally think I'm one of the most disciplined traders on earth. I really do. I honestly, I think I am one of the, is because you can't really be much more disciplined than I am. I'm not 100%, but I'm 98. I'm 98, 99%, solid discipline. And that's been my strength.
Now, a part of that discipline is even when the markets are tough, you're still doing your routine, and you have a pretty strict routine where how you're looking for stocks. Why don't you talk about that? Your starting place to find stocks with you have certain criteria for your trends and your trend templates. Talk about that and what you're looking for as a starting place to screen for stocks.
Yeah, and maybe can you actually bring up and show?
You know what? That's a good idea.
Yeah, in Market Smith, because Market Smith has taken my trend template, which is in both of my books, and the trend template is not a final destination screen. It's actually a starting point. It's a qualifier, and you want to see the grand majority of your stock should meet the trend template. And what's the 5-month trend template? There's 3 trend templates on there. There's a 1 month, which is for early turns, and that's you'll find power plays because they move very quickly and they don't give the long-term trend enough time to go into a confirmed uptrend. But those are where there's some caveats to it. Big bases too, you might have where the moving averages go flat. But generally speaking, 90% of the time, 95% of the time, the majority of your stocks should be in a confirmed uptrend with 5 months of uptrend. And So you have in MarketSmith, you have my 3 trend templates as presets, and one of them you could actually go and manipulate and change the parameters. And you can also use this to screen your whole universe. You can make it where it narrows everything down, and then from there you apply additional characteristics, and you do your screening from the trend template as the universe of stocks. So it's really great, and I know lots of people have, hundreds and hundreds and hundreds of people have sent me emails that love it in MarketSmith.
Yeah, and Mark, so right now I just pulled the regular 5-month trend template. The 5-month wide is when we removed the RS rating of minimum of 70, and also the stock had to be above the 50-day moving average. But so that's where you'll actually even find more stocks. But there are going to be a lot of people out there saying 252 stocks. That's way too many stocks. Why are you starting out with a larger kind of universe like that?
Yeah, well, that's actually not a lot of names, but I mean, it's I've seen it have 900 names.
Right.
Yeah, in a really good market. So it depends. If you're in an uptrend for a long time in the market and very strong uptrend, you'll see a lot of names. So this again, you're boiling it down. You're taking it that 250 or even 1,000 names. You're boiling it down from 8 or 10,000 names. I guess there's like maybe 15,000 names in the market. MarketSmith probably covers 8 or 10,000 of them. And now you're narrowing it down to anywhere between a few hundred and maybe 8 or 900. So you've really taken the market down to like the top 10% of trending. So now you at least know that the stocks are in an uptrend, and you've got some idea that institutions are behind them, because if you're Buchanan Slim or you're doing what I do, these are all continuation patterns that we're playing. We're not trying to get the low and the beginning of a move. We're getting a continuation of a move, trying to get that meat in the middle, which is generally the meat in the middle, or even the end of the move is usually your fastest and most powerful, especially sometimes at the end when you get blow-offs. Right. So we're trying to find where momentum is the strongest and get the fastest part of the move, so you can increase your compounding.
Yeah, and it's interesting that you mentioned the kind of the blow off move, because there have been a lot of stocks that have moved really powerfully, and let's see how the rest of the year ends. But for some of these stocks, they've just been moving so strong, that at least for me, that's kind of in the back of my mind. Are some of these going to have like climax tops, kind of really just strong kind of moves to end the year?
I think some of them already have, and of course we'll see that in hindsight. You're probably, before this is all over and you get a real secular bear market, you'll probably see the big FANG names, the mega caps, the Amazons, the PayPals. Those will probably have blow off moves. And again, I don't know if that's already occurred, but probably not. But again, you don't have to worry about getting the high and getting a blow-off move. The key is to make a decent profit. That's the goal of trading, is to make more than you risk and do it over and over. And if you're a day trader, your average gain might be a half a point and your average loss is 10 cents, right? And you make, some of these guys make 500 trades a day. Yeah. Okay, that's like, you're a bubble gum factory and you're selling bubble gums for, a half a penny, wholesale them for a quarter penny a piece, and they sell for 2 cents, whatever the numbers are. But you're doing volume. Mm-hmm. Well, you could be a Ferrari dealer and only sell a handful of cars a year, and even make more money than the guy who's turning over millions of bubble gum pieces, right? So it's just a matter of where you are. But wherever you are, whether you're a long-term investor, you're a swing trader, you're a day trader, you've got to manage the risk-reward relationship. And that's the key of trading, is to make more than you risk and do it over and over. So again, I'm not worried if the stock goes up, and if I make 20% on a stock that I risked 5 and it's a 4-hour trade, I made 4 times my risk. I know if I just did that and never ever had a stock go up more than 20% for the rest of my career, I'd make a fortune. I make a fortune if I could just do that. So that's the whole idea. And that's where, people get so hung up in trying to get these big winners and time the blow off tops and hold Tesla for eternity. All right. Well, again, though, holding it through these big declines. How do you know when the real decline? Well, the real decline, please step up. How do you know when it's the real decline? If you hold through a 50% correction, and it comes back and it doubles, and you hold through another one, eventually you hold through a 50%, it goes 60, it goes 65, and then you say, oh no, I'm in trouble here, and you've given it all back. So you have to use strength for selling, and then not worry about where the stock goes after that.
Perfect. So knowing when to lighten up in the markets and also knowing when to push it is a mark of a good trader. Coming up next, we are going to discuss a few ideas. Stay tuned.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
We are back with Mark Minervini on Investing with IBD, sponsored by MarketSmith. Okay, Mark, let's go into a few ideas here. And the first one that we're going to talk about is Dollar General, ticker symbol DG. Let me pull up the charts again here. Okay, so here's Dollar General.
Yeah. I want to preface this with I'm turning very conservative in the last couple of weeks, and I'm not finding many ideas. And I think we're kind of picking at the bottom of the barrel here right now. So we're going to try to find some names that look viable and are constructive. But quite honestly, I've been selling into the strength and moving out of a lot of names that have been moving up. And now I'm seeing a lot of laggard names start to pop up. And again, they might work, but they don't usually work as well as the leading stock. So just want to make sure everyone understands. I'm a little cautious right now. As far as the individual stocks are concerned, I think the S&P can still move higher.
Yep. Okay. So walk through what you're seeing here in Dollar General, because it did make it closed at a new high at least today.
Yeah, well, I already bought this and own it since July 23rd. So July 23rd is where
when it pulled back,
and that's another one when it came out, and then as it pulled back right to the breakout there, bought it, and now it went through a little pullback, but not enough to hit a stop. And now it came back.
So you had the patience to hold through that. I mean, a lot of people, especially when they're newer, they don't have that patience. If it doesn't work immediately, they want to get out.
Well, you not only need sit-out power, you need sit-in power too.
Yeah.
So, and sit-in power is when you first make a trade, you have an idea, you come up with, well, you should come up with a stop loss. Hopefully, you have your stop before you even make the trade. You know where you're getting out at a loss, and you want to wait and let the stock either prove you right or wrong. Now, if something goes drastically wrong and it's really acting abnormally, you might get out before the stops hit. But if everything is pretty much normal and the stock's not doing anything that wrong, you just let it either stop you out or give you the profit, and the stock works out. So again, there's some violations that I look for. A handful of violations that would let you know it's not acting normal. That's in my book, Think and Trade Like a Champion. There's a handful of violations, but this stock had not really given any violations. No major violations. So still in it. I trimmed it a little bit just because, like I said, I'm pulling back my exposure on the market here, and just up a little bit on it right now. But today was a pretty good day. You can see actually looks like it was trying to break out here, and it's a fairly tight consolidation here. It's going all the way back to June, so I think it looks pretty good. If it moves into new high ground here from here, you probably can buy it.
Perfect. Okay, so that was Dollar General. Ticker symbol once again was DG. Let's go to Visa, ticker symbol V.
So this is another one that I already own. Bought it on July 20th. We put it for our members, and usually when I buy Visa, I buy MasterCard also, or vice versa. If I'm interested in one, and if I'm going to buy a full position in in one of the names, I just buy a half position each of them because you don't know which one is going to do well. If they're both going to do well, they usually move pretty much in tandem. But as you see, in my Visa purchase on 720, I also have the MasterCard purchase on 720. MasterCard's up 6% from that point, and Visa's up 1%. So MasterCard's actually outperforming. But I think Visa might play catch up here because, like I said, they usually kind of go in tandem. But Visa, it tried to come out and break out there yesterday, and it was looking really good. And then it came all the way back, had a full squat, closed about down in maybe the 25% of its range, bottom 25% of its range. And now it's going inside. I think if you can get above that reversal and you break out from here, you can buy it, and it's pretty tight too. You can have a pretty tight stop on it.
Okay, so that was Visa. Let's go into another one that we've spoken about in the past, Ollie's Bargain Outlet, ticker symbol OLLI. And this one is back. It got crushed. And obviously, this is a David Ryan stock, as I like to call it. But he did really well a few years ago on it. But
well, we both bought it on
yes.
on the same day.
That's
matter of
right.
fact, I bought it on 2 days. And when I was buying that was back, let's see, it was back in March of 2016 originally, and then it made a big move, but he held it for a big move, and I sold it and went back and forth in it a few times. But now this came ripping back. It's a very well-run company, but that doesn't necessarily ever mean that there's a good stock. But the fact is it is a very well-run company. It tried to turn up today. Again, I think maybe if you can take out today's high, you can go in there with a tight stop, maybe below the 50-day, and take a stab if this thing moves. With some of these retail names, like even Target, I own Target, and this is, in my opinion, a laggard.
GT. Yep. Oh, yeah. This one's acting well. Yeah.
It's acting pretty well. I'm up 7 or 8% on it. Bought it on 7/31 on July 31st. Very just classic coming out of there. You can see it's tight, VCP, big cup with handle, whatever you want to call it. Been grinding higher. Again, this is a perfect example of completely going against your gut and just buying the setups, because I don't see how a retail store can survive in this world right now. But I don't know what they're doing. Maybe they're shifting to online, their model's working. I don't really know. And even if I did, I wouldn't trust that fundamental analysis unless the technicals were going to confirm it. So again, this is one that, I kind of held my nose and bought a laggard name, lower RS, but coming out of a nice base and showing some improvement here. But again, I'm not saying that this is something that you should buy here. It's too extended right now.
Right.
But I'm saying the retail area, Ollie's might be something that might play catch up.
Yeah. So I actually do have a little bit of shares of Ollie. Let's go to another retail, but more apparel type company here. And there's another familiar one, Lululemon. Yeah,
Lulu came out a few days ago and was able to come out of a decent little base, and it's held up well, So this might be able to make a bigger move here, from maybe move higher. Again, I'm not in this, and I'm probably not going to buy it, but it's kind of looking at the best of the worst right now, as far as I'm concerned.
Yeah, I do have shares of this, but it's just a slower moving stock, but it's been acting well, and obviously a little bit newer company in the last 15 years. Speaking of new companies, this is Spotify, and they went public of the last few years, I guess, but they had a rocket ship with Joe Rogan. It's going to go exclusive on them, and then I guess the Kardashians are going to do a show or something. And first time back, a pullback to the 50-day it touched, and I actually bought it a couple days ago, just a smaller position as it pulled back. And what do you like about this?
Yeah, I don't generally buy pullbacks to the 50-day. To me, it's a very obvious, and I feel like it's a remedial strategy. But it does work in a powerful name, especially the first pullback. You can get a good trade out of it. A lot of times, these market leaders will go an amazing distance without even closing below the 50-day. And pullbacks to the 50-day are a good place to add. Institutions will use that 50-day sometimes to add. So you got to see how it acts around there. I mean, if this maybe went inside for a few days and turned up, I might get interested in it.
Perfect. Okay, so that was Spotify, ticker symbol SPOT. This is one that probably most people haven't seen. Puxin Limited Ads, Epoxy Limited. It's a Chinese company, and the ticker symbol is NEW, NEW.
Yeah, this is a low-priced power play type name that tried to come out of that little base on August 7th, then squatted. So now what I look for, and again, this is my terminology, reversal recovery, squat, early day reversal, these kind of terminologies. I'm looking for this to reverse and to take out those highs. Again, this isn't something that I'd probably be in. But it is a name that's holding up and acting constructive here. So something that you could look at if you're a little more out on the risk curve here.
Excellent. And so let's go one more here. This is Amazon, that I'm sure no one has heard of ever before,
Yeah.
but it still can continue to hang in there, Mark. It's now over 3,000.
Yep. And, again, it's just putting in another little consolidation. And I think it's becoming more and more obvious, obviously. Even, Tesla recently moved sideways and put in a little consolidation, got real tight. It came off for a few days, shook out, and then came ripping back today.
Right, exactly. With the
Tesla,
5-for-1 split, right? 5-for-1. It was 5-for-1, I think. Yeah, it's 5-for-1
yeah.
split.
So these are the leaders. These are the big cap, mega cap. FANG leaders that you got to give them the benefit of the doubt. And like I said, I think that these are the names that you really have to gauge for a secular bear market. You got to get these to top first, and then you might even have a lead time even before you get a bear market, because the big long-term leaders usually top well in advance of the market.
Now let's go to the semiconductors, the SOX. I'm gonna pull it up. It's 0SOX. And this made a new high today. So it's pretty incredible that the semiconductors, they just keep cranking it out and keep hitting new highs, even when the market has been a little bit more volatile over the last month.
I think it's impressive. I thought we might lose the stocks, lose the semis when the biotech started coming under pressure. But yeah, the semis are still holding up here. So KLAC had I think a decent day today, right?
Yeah, it did.
It was
Yeah, it was
coming
up
out
3.72% today.
Yeah, trying a little base there, maybe for 5 weeks or so. Yeah, so the semis still look good. It's a big group though. There's a lot of names in the semi group, so you can very easily end up in laggard names because there's so many names, and even after the key stocks move out, you can get stocks moving out on basis for months and months and months because there's just so many. But like I said, I was buying, like TSM and going all the way back to LSCC. That was quite a while ago. Those were really, more leading names.
And you mentioned biotechs. I'll pull up the ETF IBB here, and the biotechs were really strong out of the gate. It was a little bit more concerning over the last few weeks when they'd started to break down, and the ETF now is below the 50-day moving average.
Yeah, are you talking about the IBB?
Yeah, IBB. Yep.
Yeah. I mean, it's looking a little bit ominous here, but they may come ripping back. Like I said, you got to really look at the individual stocks. Something like Tandem, TNMD.
TNDM. Yep.
TNDM. I'm sorry. Yeah, TNDM. This is one that I owned, but I'm out of right now. But there's still some names that look interesting here. That had a nice breakout. We actually bought that on 630. Had a nice breakout. So this is still really above. Yeah, still above. We're just pulling back to that breakout. May take a little time to recover. Even Amgen had a big breakout, and I was in Amgen, but it didn't hold up like I would have liked to. That also had a breakout on July 1st. It came out of a big base, had a big day. It was holding up nice, and now it's just drifted off with the IBB. But again, coming back to the breakout, it will see how this pans out. But I have a feeling that it's not the end of the biotechs.
Perfect. And let's just quickly, it looks like we have a few more minutes here. Let's quickly walk through a few other leading stocks, and we'll just get your thoughts on them. Here's Zoom. I just pulled that up. It broke the 50-day yesterday.
Yeah, I feel like Zoom is a key leader,
Yes.
and this is one that, again, it's coming off a bit here, and it's a little disappointing that it's not continuing higher here. But I think this seems to be a key leader. I wouldn't buy it now. I would wait, for it to come out of a consolidation. But that TDOC also had some trouble, TDOC. So this is the benefit, the COVID stocks where they're benefiting from online. We're using Zoom now. Everybody's using Zoom. I don't see how Zoom's, we actually my assistant tried to contact Zoom to get some questions answered about, our Zoom platform. And they sent back an email, said, look, we can't even talk to you. We're just too busy. We're too busy. I was like, okay. Yeah, they're making money. So, yeah, they can't even give you customer service because they're so overwhelmed with new business. And you're getting a whole generation of people that have never, maybe even been on the internet much, and now they're getting enabled with this, all the doctors and so forth. Yeah. So TDOC, Zoom, you got some of these names, of course, the PayPals, the Apple, Square, DocuSign. Those are all the leaders of this bull move.
Yep. Here, and I'm just pulling those up. Of course. I pulled up Square right here. It's just been a rocket ship, and I pulled up PayPal before that. Apple, obviously. Apple.
Yeah, again, you take a look at something like a Square. It's held its 20-day the whole move, just like the Nasdaq. Just holding the 20-day the whole time. DOCU is just starting to pull back here, but I mean, what a move! I mean, just grinding higher, and I call them natural reactions and tennis ball action. This is a perfect example of just natural reaction after natural reaction, just little pullbacks back into new high ground, short pullback back into new high ground. It's no pressure ever on you when you're in this trade, and that's the key of an easy dollar environment.
I almost feel like this was the best acting stock out of all of them, because it still hasn't touched the 50, but it couldn't even break the 21-day for months.
No, it's just been moving higher. And again, like I said, very shallow pullbacks and right back into new high ground. That's what you want to see. That's what you want to see. And that's what tells you to hold the stock for a bigger move. When you buy it, it moves up. You go through that first pullback, it goes right back into new high ground. That's telling you the stock's strong. Stick with it, go through another pullback, and then see how it responds. If it pulls back shallow, gets it to new high ground again, stick with it. Maybe, it gets sort of extended, you sell a little bit of it, but you want to play it for a bigger move when it's acting that well.
Perfect. Now, Mark, so you've talked about a number of things here. Everyone can learn more about how you trade in your books, but there's also a pretty interesting opportunity this year, just because of the pandemic. You're doing your Master Trader program, which you do every year. I've been to it a couple of times. MarketSmith sponsors the event too. It's usually in Myrtle Beach every year, and I look forward to going there. But this year, since of the environment, you're actually doing it online. Just talk briefly about it. I think it's a pretty cool opportunity for those who are interested in the way that you trade. They actually don't have to go to Myrtle Beach now.
Well, people love to come to Myrtle Beach because it's beautiful and it's in October. It's a beautiful time, but they love to come. They want to meet myself and they want to meet David Ryan and they want to meet all the other traders too, because we have people from usually it's 60, some odd countries that come, couple hundred people from all around the world. So you just get this real cross section of traders from all over. It's really interesting. And you've been there.
It's great. It's fun.
It's an awesome lot of fun. The event is a lot of fun. But this time, of course, because of the COVID situation, we're not going to put 200 or 300 people 2 feet from each other from around the world. I think it would be irresponsible. So we're doing it online again, Zoom, and there's a big benefit to that, I think. First of all, of course, we've got lots of signups from places that people couldn't travel from. And so people who aren't able to make the trip can now enjoy it and learn. But some people are upset, because it wasn't in person, but and other people are very happy about it. There's a big benefit to that because we're spreading it out over more days, and we're gonna really, and it's like drinking from a fire hose. It's a lot of information, and we do it in 3 days usually, and now it's going to be over 5 days, and we might even do some Q&A days in between. Maybe it's going to be 7 or 8 days. So you'll get to really get the information in a slower, more methodical fashion. So I think there's a benefit to that.
No, yeah, and how can they find out about that, about the event, Mark?
Yeah, well, they can go to Minervini.com. I think the event actually for stock traders, right?
Yeah,
for stocktraders.com. I hope that's the right.
As you can see, we didn't even prepare this.
No, I didn't prepare this. 4 stock traders, the number 4 stocktraders.com. Yeah, that goes to the event page.
Perfect.
Yeah.
Okay, so there are a few ideas that we went over, a bunch of ideas that are worth considering and at least adding to your watch list. And of course, definitely check out the information on Mark's event. So Mark, thanks so much for joining us today.
Okay, I tried to get a lot in today. I talked fast so we can get a lot of information in.
Yeah, so you can slow it down, everyone, on the podcast.
Exactly.
And absorb the information. Next week, we are going to have Catherine Wood on the podcast. Catherine is the founder and CEO of ARC Investment Management. So that's it for this week on Investing with IBD. I'm Arusha Pierce, and thanks for listening.